This video covers contingent liabilities, also known as loss contingencies. And this means amounts that the company may have to pay out in the future. It depends on something, something that's going to be decided later on. But it relates to something that happened in this accounting period. And when I say that it occurred this accounting period, I'm thinking about whether or not we're going to record the journal entry this accounting period. Of course, it's possible that you could see on the balance sheet a contingent liability based on something that occurred in a previous accounting period that still hasn't been paid out. But when we're talking about, are we going to record a journal entry, we look at, did the event occur this accounting period? So let's say a plane crash happened this accounting period. The lawsuit might not be settled for another into next accounting period or possibly multiple years from now. But if the event occurred this accounting period and we think it's very likely that we're going to have to pay out, we need to record a journal entry. And that takes us to the next decision for the company is how likely is it that we're going to have to pay out? Okay, and so we think about this as a spectrum from there's a remote chance that we might have to make a payout to a probable chance. And probable or likely. And this is the terminology used by GAAP. GAAP says that the company needs to decide, is the likelihood of payout, is it remote? Very, very unlikely. Or is it probable? So something across this. Obviously, if it was certain, then we would just make the payout. We wouldn't have a liability. And somewhere along the spectrum, we're going to use the term reasonably possible. And this is the terminology GAAP uses. So managers obviously have to use a lot of discretion and estimation to decide, is this payout, let's say, is this pending lawsuit, do we think it's based on something that happened this accounting period? We're recording should we record the journal entry? We need to estimate based on past experience, what other companies in the industry might be doing, similar lawsuits, how they were settled. Okay, so the rule is record a contingency when it is probable that the liability has occurred. And then it's the amount of the loss can be reasonably estimated. This is another term used by GAAP. And so what does reasonably estimated mean? You can make a fairly good estimation, right? If you think you're going to lose a lawsuit, but you have absolutely no idea how much you're going to end up paying out, somewhere between $1 and $6 billion, you can't reasonably estimate it. But based on prior experience, if you can estimate we're probably going to have to pay out between $1 and $2 million next period, then we can estimate it. So we need to memorize these rules. If we meet the two criteria, the journal entry is exactly what you would expect. Nothing surprising here. We would debit a loss account, loss contingency, lawsuit loss, possibly in some sort of lawsuit expense for some dollar amount. And this loss, of course, this portion of the entry would, of course, decrease net income. And the credit, well, we owe, we're based on something that happened this accounting period, we have some sort of liability, let's say like a lawsuit liability. And of course, this would increase liabilities. Need to write that out there. Okay, and then anytime a journal entry is recorded for a loss contingencies, the company needs to describe it. GAAP says describe the nature of the lawsuit, if it's a lawsuit, the nature of the loss contingency. In the notes to the financial statements. And these notes to the financial statements are also often referred to as the footnotes, and so I'll be using that just as a shorter way of writing this out. Remember, with financial statements, we have the four, in an annual report or a quarterly report, we have the four main financial statements: the balance sheet, the income, the statement of cash flows, and the statement of changes in stockholders' equity. And then behind that, we have pages and pages, sometimes 100 or more pages of information detailing what's behind the financial statements. So when thinking about what companies might have some lawsuits pending, I checked a few companies and didn't find much until I came to Facebook or Meta. So here's their balance sheet. Okay, $366 billion in assets. And we're looking at the liabilities. And the lawsuits or contingent losses are going to be buried in this accrued expenses and other current liabilities of $31 billion. And so if we come to the footnotes below the financial statements, we see this is note 9 of, I'm not sure how many, maybe about 15 to 20, and we're already on page 110. Okay, so this is going to give some other information. We see of the 31 billion in total accrued expenses and other current liabilities, we see they have 7 billion in legal related accruals. And of course, investors are going to want to know more information than just 7 billion. And so we can scroll down to note number 11 and look at some discussion of these legal, the lawsuits that Facebook is involved with. And so you can see here, we're not going to go through all of this, and you're welcome to do it on your own. But here is where they get into the specific cases, where they stand, what led to these cases. And Facebook has many lawsuits that are pending. So this just gives you a little idea of what these disclosures might look like. Okay, but let's continue on with the accounting treatment. We need to talk a little bit about, so we said if it's probable and that a liability has occurred during the period and the amount can be reasonably estimated, we know that we need to record a journal entry. But what about when we're on other parts of this spectrum here of likelihood, and what if we can't estimate it? So GAAP gives us some information about contingency. What do we do with this loss contingency based on the different outcomes of likelihood? Okay, so we have the likelihood can be probable. And under the loss contingency, let's say it is reasonably estimable. And yes, in, 5-6 years' time, you will be throwing around terms like reasonably estimable in your daily life and not even question it. Can we estimate it? I mean, normal people would say, can we estimate it or not? And we just said if it's probable and reasonably estimable, yes, we record the loss and liability. and we disclose it in footnotes. If it's probable, but we just cannot come up with a reliable, any sort of estimate of how much we might have to pay out, then of course we can't record the journal entry because we don't have a dollar amount, but we must disclose in the footnotes. Okay, if the likelihood management decides that the likelihood is reasonably possible, but doesn't reach that probable threshold, of course this requires a lot of judgment, and then we don't record the journal entry, but we do disclose in the footnotes. And if it's reasonably possible and we cannot estimate it, still disclose it in the footnotes. We want to give investors this information. Okay, and if the likelihood that we're going to have to pay out is remote, think about it's possible that we're going to have an earthquake and we're going to have to pay to rebuild our factory or corporate office, but that likelihood of the earthquake is remote, then we do nothing. No journal entry, of course, no disclosure. One more piece of information to add is what do we do? So we talked about here's our timeline. Here is the start of the fiscal year.
Mom, can I come in?
No. And then we have the end of the fiscal year, December 31st. And then sometime for a December 31st year-end company, which most companies have, sometime generally between February and March, the financial statements are issued. And you might be wondering, why does it take so long? You might be wondering, like, what's happening in this time here? Adjusting journal entries are recorded. The company is making sure they're checking every account and making sure everything looks right. Then the auditors come in and they are confirming all of the information in the financial statements. And then the auditors have to give an opinion about whether those financial statements are consistent with the rules of GAAP. So we have this time frame here. So sometimes new information comes out that relates to this fiscal year that the investors care about. And so the question is, if new information comes out after the financial statement year, the fiscal year ends, but it relates to that fiscal year and is before the financial statements are issued, what do we do? And GAAP says, take into account information that comes up after the fiscal year ends, but before the financial statements are issued. If we know about it and it relates to our fiscal year, then we tell investors about it. That should make sense. And by issued, we mean given to investors, released to investors. Remember, if it's a publicly traded company, anyone can access those financial statements. Okay, so that's everything we need to know for the loss contingencies. What if we have to pay out in the future? And how about gain contingencies? What if we think we might get money in the future? Okay, even if a company expects to receive, even if it's very likely, very probable that we're going to receive cash in a future accounting period based on something that happened this accounting period. Let's say we are suing someone else this accounting period, and we think we're going to receive cash in the future. We don't record anything. This can be a lawsuit. It can be receiving money from an insurance payout based on something that happened this period. So no gain or receivable is recorded. And you might be wondering, well, that's not fair. How come we have to tell them the bad news? We might have to pay out, but we don't get to tell them the good news. Same reason we don't want to, the student wouldn't want to tell their parents, I'm pretty sure I'm going to get an A in a class, because it sets the expectation. And what we don't want to happen is our investors to think that we're going to get it, and then something goes wrong and we don't get it. And then investors penalize us because they made their investment decisions based on our financial statements. Okay, now if a future cash receipt is probable, then we're still not going to record a journal entry and have the balance sheet and income statement reflect gain and a receivable, but the company may choose to disclose it in the footnotes to the financial statements. We just have to be careful. Don't ever make it look too good, because investors are making these investment decisions, and we don't want them to sue us for making us look better, our company look better than it really was. Okay, I don't know whether I should write it here, but be careful, be judicious, be very cautious in all the good news that we're going to tell investors.